Today I'm actually going to take you guys over to a brand new spot we haven't filmed in yet. It's right over here in my neighborhood in North Beach, and it's a little noisy over here, but it's going to get a lot quieter pretty soon because we're going to go right over by the bay. And there's this brand new building over here, which I can't even remember the name of it, but it's a beautiful building, super expensive of course, and they put in a public bay walk behind the building, so we're gonna go check that out. One thing I want to cover today that we kind of briefly touched on in a video last week was renting to own, and somebody made a really important comment that I want to address, because there's a difference between a lease purchase agreement and a lease option agreement, and even real estate agents can get this confused because they are two separate things, but they sound basically like the same thing. And so the main difference between these two things is when you're looking at the lease option agreement, this allows you to decide if you want to move forward on purchasing the place after the rental term has ended. With a lease purchase agreement, then it's an obligation for you to move forward with the purchase. So that's really the key difference, is the option. That term option is what makes all the difference of whether or not you must purchase the place or not, essentially. Check out this view, guys. It's beautiful back here. That's the place. I've only seen a few people walking in and out of here. I don't think they have too many residents yet. Now here's one thing you got to understand if you're going to enter into either one of these agreements, is there's a lot of boxes to check essentially when you're looking at a lease purchase agreement or a lease option, because the thing is, pretty much everything is up for negotiation. Everything down to the agreed purchase price in the end, the down payment, how much equity stake you must reach in the property, the closing costs, you name it, guys, it's up for debate. And so that can be a good thing if you want a lot of flexibility, but it can also work against you in case you have a hiccup. Like we talked about last week, one thing that's happening to a lot of people in the UK right now who are in these lease option agreements is if there's a single hiccup, meaning like you miss one payment, then that's usually grounds for your landlord to revoke that lease option agreement, and any of the said money that you've paid into the property is no longer going to go towards the purchase, and they can actually kick you out then, you know, because it's a violation of the lease agreement as well. There are a lot of pros and cons to this situation. What it all boils down to is if you're going to get into either a lease option agreement or a lease purchase agreement, then you pretty much need to be certain about a couple of things. And one thing I would say for sure that you need to be certain about is you need to be certain you want to buy that property, guys. That's the first and foremost thing. I would not be getting into this as like a maybe, you know, maybe I'll buy it, maybe I won't, because if you do that, then you could find yourself in a situation where chances are you probably aren't going to follow through with the deal. And when you get into these type of agreements, you'll typically end up paying quite a bit more in rent than you would if you were just to rent a place that doesn't have one of these options, because that additional money that you're going to spend in rent will go towards the purchase price. So if you're not certain, you definitely shouldn't jump into this, especially if you're looking at the lease purchase agreement without the option, because you're basically guaranteeing or promising that you're going to buy this property, and if you don't, then there can be legal consequences as well. Now obviously the potential seller would need to take you to court and basically force you to buy the property and all of this and that, but really it hurts you as well, because the amount of money you paid in that was supposed to go towards a down payment is now lost, and you have no equity in the property. And there's essentially a huge list of things that we can go over in this video, but I don't think I will, of why you should or should not do one of these. But that's a beautiful noise. Gotta love the sound of remodeling. But if you ask me, what this comes down to, probably the person that this makes the most sense for is somebody that for sure wants to buy, and you want to buy that property that you're looking at doing the lease option or the lease purchase, but the caveat is you don't really have enough money for the down payment. And especially in a world like today where home prices are through the roof, this could help you out, because let's say, you know, you need to put 20% down in order to qualify for the house, which is not the case for everybody, but let's say it is, but you only have 10% or maybe even less than 10%, then this gives you a chance to get into that property now before you can actually afford to buy it, for example. But then again, you know, you agree on the purchase price ahead of time, and if the market moves down, you know, between now and the time you actually buy it, that can be problematic for you. If the current owner has financial troubles of their own and goes into foreclosure, they can literally lose that property and you have no claim on it as well. So there are lots of downsides to this, and I just want to make sure people are aware of some of these in case you ever get into one, because it can sound like a pretty appealing option right now with just how unaffordable housing is, and it can work out for the right people, but just know what you're getting yourself into if you decide to jump into one of these agreements. That way you know more or less what to expect. Now, another thing that I found out today that I just couldn't believe, which I knew instinctively, but when you actually read the figures on something like this, it's just unbelievable, guys. And that is, average American workers right now earn about $27.45 per hour as of June 2022. And back in 1972, the same average American worker made about $3.88 an hour. So you can say, wow, that is a tremendous increase in wages over the years. And yeah, it is. But because of inflation, especially now that we have this ridiculous inflation going on, that only actually amounts to 12 cents more an hour than what people made back in 1972. And if you guys remember my video from several weeks ago when we talked about the gold standard, what happened back in 1971? They took the dollar off the gold standard. And what do you know, guys? Ever since then, inflation has completely destroyed the average American's earning potential. Even though the dollar amount that you earn has gone up significantly, what it actually amounts to in the end, when you factor in inflation, is significantly less. And that's part of the problem that people are having right now that we're seeing the price of everything go through the roof. So the reality is that wages have actually been stagnant for the past 50 years. And the cost of everything has obviously been rising, and the amount that people are earning today has not really been enough to keep up with inflation. And this is why we're starting to see things like the gap between the middle class and the poor become further and farther away from each other, because everything continues to go up in price, guys. It costs more to produce everything nowadays. You know, nothing is getting cheaper. So this is a very worrying statistic for Americans, and I'm sure this probably applies worldwide too, guys, because ever since the dollar came off the gold standard, every country suffers from this, because the dollar was backed by gold, and now that it no longer is, the value of the dollar has plummeted along with many other currencies, since all the values of other currencies are essentially tied to the value of the dollar. So the less the dollars are worth, the less everyone else's currency is worth essentially too. So it's a problem for every country essentially because of this. And the article I read this in, of course, gives some suggestions on what the average person can do to help mitigate this, but it's not really that helpful. I mean, they say things like invest in passive income sources, and they name real estate as a passive income source. And I can tell you guys, as being a landlord, real estate is not passive income, guys. I know it gets called that all the time, but let me tell you, it is not passive income. Being a landlord is actually a lot of work, and unless you have a property manager doing 90% of that work for you, you're going to be doing it all yourself, and you're going to be earning your money as a landlord. Let me tell you, it's not going to be free money. Yeah, does the check come in every month? Sure, it does, assuming the tenants pay the rent on time and you don't have any other major expenses going on. Yeah, then that part's passive. But you still have to keep up with maintenance on the property. You still need to address things that need to be paid for and repaired over the years. And so it's definitely far from passive income. But, you know, it's better than working for every single dollar that you have to earn, that's for sure. But the reality is, guys, if people are struggling to make ends meet, it's going to be very difficult, if not impossible, to become a landlord and actually earn enough money to create these passive income sources. So that's my first gripe with this. I think the other suggestions they have for people are more realistic, like changing which job you have, getting into a better line of work where you can actually earn more money. That's a more realistic approach to it. That, along with the fact of you can get a side hustle and start earning more money on top of your regular job, that's an option as well. So there are things that you can do, but it's gonna take a grind, guys. There's no question that life is already hard enough. And if you want to get ahead of inflation, you're going to have to work your way there, unfortunately. There's really no way out of it other than that. You're gonna have to find a way to earn significantly more money than you do right now if you want to get ahead of inflation and ever have a chance of having a prosperous life, essentially. Because if you just look at the average wages and where things have gone in the last 50 years, hasn't really helped people out that much. Now, I read something else today that I thought was extremely fascinating, and I want to know what your guys' opinion is on this. And basically, it was an article telling people that if you're able to get approved for a mortgage right now and you have a large chunk of change, then you should still buy a house right now. And I want to give you the counter argument, because so many people I see in the comments are always saying these type of things. So I want to put this in today's video and get everyone's opinion on what you think about these strategies and where things are going from this. So one of the reasons they're telling people that you should buy right now is because buyers now have an opportunity they haven't had for 2 years, which is basically buyers can negotiate price, inspection, and concessions. And to me, that one just makes me laugh, guys, because that was always the situation, with the exception of the last 2 years, because things were so insane. And are we ever going to see a market this insane again in our lifetime? My guess is probably not. Is it possible? Sure. Likely? Probably not. Because a lot of people are saying, well, there's still a huge demand for people to buy out there. It's just that now the prices are so high and the interest rates are so high, a lot of people can't, even if they want to. And I agree, that is actually true. But the thing is, these interest rates are probably not going to come down anytime soon. Even if the Fed does pivot at some point in 2023, it's going to be a while before mortgage rates come down. And look at what mortgage rates were during this run-up. People were getting 2.2% mortgages, guys. Those days are likely gone forever. I don't see them ever coming back in reality. And more likely, when mortgage rates start coming down again, I think the average rate for most people is probably going to be in the mid-4s or the low 5s. That's probably going to be like the new normal, because that's just more realistic, to have interest rates at a more sustainable spot. And having these, super low interest rates was basically a historical anomaly when you look at it. Anybody who watched the channel have a boat in Miami, guys? Come pick me up. We can do one of these videos, like we do a little boat tour around the islands here, and I can just be shooting that and talking about real estate while we're driving past all these million-dollar homes on the water. So let's do some boat videos together, huh? Now, one of the other reasons that this article is telling people that they should buy right now is because if you can afford it, if you can qualify, and you have the down payment, then yes, you're stuck paying these high interest rates right now, but eventually they're going to come down and you'll be able to refinance. Okay, on the surface that sounds like logical and reasonable advice, but remember, guys, the dynamics that are at play right now in the market that are going to be causing interest rates to go down are the same dynamics at play that are going to be making home prices go down as well. So if you buy right now with the full intention that you're going to refinance in the future, then that can be very problematic for you and potentially impossible, because as the property value goes down, you're not going to be able to refinance even if you want to when rates are lower. Because if you get in at today's prices and today's interest rates, as the property value comes down, you're losing equity by the month and therefore likely will not qualify to refinance when you actually want to. So that is a huge problem and a very misleading thing that I'm seeing right now in the market, because everyone keeps saying, yeah, I can just refinance, I can just refinance. Well, Yeah, maybe you can, guys, if you put 30% down, or maybe even more than that, and you go into the property with a really strong down payment, then you'll probably be able to survive the downturn and refinance anyways when the time comes. But a lot of people don't put 30 or 40% down on their home purchase. A lot of people put 10% down, 5% down, or even 3.5% down if you're doing FHA. You know, a lot of buyers don't put the 20% down or more that you probably should, to give you a little bit of a safety net or insurance policy in a situation like this. So if you've heard that one already a million times, be very skeptical, guys, because refinancing is a great idea, but it only works if you can actually do it. And the other part of this argument is, you know, if you wait for interest rates to go down too low, then you're going to have a lot of competition. A lot of buyers are going to come swarming back into the market when rates go lower again, which is probably true. You probably will see a lot of people come back into the market. And, you know, when that happens, then eventually that'll be enough to drive prices back up. But I feel like what could potentially happen is, even though we have people coming back into the market to try and get those low rates, in a recession like we're heading into, I think it's going to be much more difficult for people to actually get qualified for loans than it was before. You're already starting to see banks not want to lend to people for credit cards, for example, if you don't have like a 650 or higher credit score, guys, or even higher in some cases. So you're probably going to see a similar situation happen with mortgages pretty soon, where only the most well-qualified borrowers can get a mortgage in recessionary times. And if you're not one of those people, then you're not going to be able to. And you also got to remember that during a recession, demand for housing is probably not going to be very high, because a lot of people are generally hurting financially in a recession. So counting on the fact that you're going to have a ton of buyers swarm back into the market during the recession is a possibility, but probably not likely, because if we look at what happened during the last recession, you know, most people couldn't buy anything because their financial world got completely flipped upside down. So even when rates are lower again and home prices are lower, even people that maybe would want to buy might not actually be able to. So you need to keep that in mind as well. There was another report today talking about how the pandemic boom towns are the places now that are seeing the highest levels of inflation. And just like we talked about the other day with the housing market being different in your area, depending on where you live, can easily dictate how much home prices may go down. And depending on where it is, the differences can be quite a lot, guys. The last comparison was Chicago versus Phoenix. You know, Phoenix could be looking at a 40% price cut, whereas Chicago might only be a 3% price cut. So that's a gigantic difference, and obviously is going to make or break the future of their housing markets. But when we're looking at inflation, you know, not everyone is also affected equally by inflation, but if you live in some of these popular pandemic boom towns, inflation is much higher, and Phoenix actually has it the worst. They're the #1 on the list. And then followed up by Phoenix is Atlanta, Georgia, and Tampa, Florida, and then of course Miami, Florida. And as a local, guys, I'm feeling it. I can definitely confirm that the inflation here is out of control. Everything costs roughly double than it did a few years ago. And if you think I'm exaggerating, just ask other Miami locals. They will tell you, guys. You can see it at the gas pump, you see it at the grocery store, you especially feel it, and the cost of housing, doesn't matter if you're renting or buying, it is insane. And so places like this are feeling the squeeze much more than, say, some middle of nowhere town in the Midwest, like where I'm from. Probably not feeling the inflation so much. Maybe at the grocery store and the gas pump, but probably that's it. But to take it a level deeper, you can actually calculate your own personal level of inflation, because it even gets more granular than that, and everyone's situation with inflation is going to be better or worse depending on so many different things, like where you live, for example. People that need to commute 1 hour each way to work in their car are going to be feeling a much bigger squeeze by inflation than people that, let's say, live in a city environment like this and can walk 5 minutes to work every day. So that can be a huge driver for inflation for somebody. And then there's other things like retirees, for example. You know, housing is one of the biggest costs when it comes to inflation right now. And if you don't have a mortgage payment anymore, then your personal inflation rate is going to be significantly lower than somebody that has to pay $1,700 in rent just for a one bedroom. Or if you live in Miami, a one bedroom now is like $2,200 a month, even in a piece of crap building, guys. So it's just nuts. So those things can make a giant difference on the amount of inflation that any particular person is feeling right now. And what I think is going on due to the abundance of remote work opportunities right now, and the fact that people are now looking at moving to other countries. Like, for example, there was an article today talking about how many expats are moving to Mexico, for example, because the cost of living there is literally a third of what it is in the US. And if you make dollars or euros or British pounds and you move to Mexico, you're living like a king on, you know, salaries from these countries. And the problem is with this is it's the same dynamic that we saw during the pandemic with popular places like Miami and Phoenix and different areas like this. It basically makes the entire area unaffordable for locals, people that have lived there their whole lives and you know, grew up there or have maybe just lived there for a long time. No longer can keep up with the cost of living in places like this. And what's happening in Mexico is actually the perfect example of this right now, because a lot of the locals are having to now relocate away from Mexico City, which is a very popular place that expats move to, and it's just getting so expensive there that people can't afford to live there anymore. It gets even crazier. Like, people are not just taking over the rentals and buying up the housing there, they're also opening businesses and renting out the retail spaces and different things like that that are basically pushing some of the locals out. And you know, it's kind of like one of those situations where you have to either adapt or die. And as somebody who kind of went through this here in Miami, I think I'm in a unique position to kind of speak on this. Like, for example, when I moved here, it was very cheap to live here for a big city like Miami. I mean, I shared with you guys, I used to pay $900 a month in rent in that piece of crap building over there, but it's on the ocean and now it's condemned. But luckily it wasn't condemned back then. And so that was affordable back in 2008, essentially. And now, you know, if you could pay $900 a month in rent here, that would be like a godsend. You know, it's almost unheard of to find something that cheap now. So even though I have become a Miami local, I'm not from here, but I've been here long enough that I have become a local, I have had to adapt to the rising cost of living here. And if I just stayed working the restaurant job like I did when I first got here, I wouldn't be able to keep up with the cost of living, and I would be one of those locals being pushed out. So it's kind of one of those situations where you either need to run with the big dogs or you're out of the race, you know? And that actual situation has pushed me personally to, you know, work harder and make more money to keep up with the cost of living here. I'm not concerned about keeping up with the Joneses or, you know, what does this person have? I don't need to own something in this building, but I like living a comfortable life, guys, and it's worth fighting for me. And so I have done everything in my power to work harder and make sure I make it happen. But people that can't do that for whatever reason or are unwilling to are simply going to get pushed out. And I think you're going to see that happen in more and more popular destinations across the US and across the world, like what's happening in Mexico. And to me, the only way that this is going to get better is if people that don't want to hack it in places like this, you need to move to these unknown places in the Midwest or whatever that are super cheap, and make those cities that are not so great into great cities once again. Because I feel like that's going to be the only way for people to live an affordable lifestyle. And guess what? Once that place becomes the new gold mine, everyone's going to be running back to your city, and that's going to be the next unaffordable place. It's just human nature. Everyone wants to be in the popular and hip spots where there's lots of money to be made and there's fun things to do. So this is just the world that we live in today. If you guys enjoyed this video, make sure you hit the bell notification down below. YouTube will alert you every time I have a new video. And if you don't want to wait, check out my next video on the screen right over here, and I'll see you in the next one.